السلام عليكم ورحمة الله وبركاته. Managerial Accounting Pricing. Now we will continue learning objective number 4, determine transfer price using the negotiated cost-based and market-based approach. In the previous recording, we discussed this multiple choice equation and the answer was 70 because the division is operate in full capacity. The minimum transfer price was 70. How we come to 70? It's the variable cost 30 plus the opportunity cost. Opportunity cost equal the contribution margin 40. The difference between selling price 70 and the variable cost 30 equal the opportunity cost 40. So the minimum transfer price now in full capacity, operating at full capacity, equal variable cost 30 plus 40 opportunity cost. The answer is 70. But now if we assume that the division is not operating at full capacity, in other words, there is excess capacity. In this situation, new situation, if there excess capacity, the minimum transfer price will be 30 because the opportunity cost equals 0. Effect of outsourcing on transfer pricing. Outsourcing, contracting with an external party to provide good or service rather than doing the work internally. As we see in chapter 7 in incremental analysis, the case of make or buy situation or decision. Virtual companies outsource all of their production. Use incremental analysis to determine if outsourcing is profitable. What is more profitable, make or buy? Make internally or buy from outsourcing? As companies rely on outsourcing, fewer components are transferred internally, thereby reducing the need for transfer pricing. Transfers between divisions in different countries. When the company is multinational or when the company is international, companies globalize their operation. Going global increase transfer between divisions located in different countries. These companies has a lot of transfer prices. As you see, 60% of trade between countries is estimated to be transfers between divisions. Upstream sales, downstream sales, horizontal sales. These sales are regard to our applied the transfer prices. Need to apply transfer prices for these transfers between divisions in different countries. Different tax rates may determine appropriate transfer price more difficult. Now, when the company has to transfer goods from country A to country B to other division, they consider the difference in tax rates. Simply, they prefer to show profits in the country with low tax rates. The clock division of control corporation manufacturers clocks and then sells them to customers for $10 per unit. This to outside customer. Its variable cost is $4 per unit and its fixed cost per unit is $2.50. This is the current situation and deals with this production with outside customer, sell to outside customer. Now management would like the clock division to transfer 8,000 of these clocks to another division within the company at the price of $5. Also, clock division sells this clock to outside $10. They wants the clock division to sell it to the other division only at $5. The clock division could avoid $0.50 per clock of variable packaging costs by selling internally. As we noticed in the previous recording, variable cost to internal sales may be high or less. In this case, the variable cost is less $0.50 because we avoid packaging cost of selling internally. Determine the minimum transfer price, assuming the clock division is not operating at full capacity. If the clock division is not operating at full capacity, this means they have excess capacity. In this case, the operating cost will be zero. Will variable cost equal $4 less $0.50 equal $3.50. So the minimum transfer price $3.50. Again, now because the division is not operating at full capacity, this means it has excess capacity. So the operating cost will equal zero. Minimum transfer price will be only the variable cost, the new variable cost, which equal $4 less $0.50 equal $3.50. Number B, the same exercise, but determines the minimum transfer price assuming the clock division is operating at full capacity. If the clock division operates at full capacity, this means no excess capacity. The opportunity cost will be the contribution margin realized by clock division. The contribution margin equal 10 less $4 equal $6. Again, opportunity cost here equal contribution margin. Contribution margin $10, selling price ناقص variable cost $4 equal $6. Plus variable cost, a new variable cost to sell internally, it's $4 less $0.50 equal $3.50. So the minimum transfer price now is $9.50. Here, exercise The appraiser department of Easy Mortgage Bank performs appraisals of business properties for loans being considered by the bank and appraisal for home buyers that are financing their purchase through some other financial institution. So this service for appraising may be due to internally customers or to outside customers. The department charge 280 per home appraisal and its variable costs are 220 per appraisal. Now this department for charge for each appraisal $280 and realize variable cost 220. So the contribution margin per each charge equals $60. Recently, Easy Mortgage Bank has opened its own home loan department and wants the appraisal department to perform 1,500 appraisal on all Easy Mortgage Bank financed home loans. Now we will discuss the transfer price for this service internally to perform 1,500 appraisal internally. Bank management feels that the cost of this appraisal to the home loan department should be $265, not 280. The variable cost per appraisal to the home loan department would be $10 less than those performed for outside customers due to saving in administrative costs. Also, the new variable cost for internally service will decrease to 210. Instruction: determine the minimum transfer price assuming the appraisal department has excess capacity. When the appraisal department has excess capacity, operating cost will be zero. The operating cost equal zero. So minimum transfer price equal a new variable cost. The new variable cost for internally will be 220 less 10 plus the opportunity cost zero because the existence of excess capacity zero, the opportunity cost. So the minimum transfer price will be 210. Determine the minimum transfer price assuming the appraisal department has no excess capacity. B, because no excess capacity, we will add the opportunity cost. The opportunity cost will equal the contribution margin to this appraisal service to outside customers. So minimum transfer price equal a new variable cost 220 less $10 plus the operating cost equal the charge for outside customer less the variable cost when perform this service to outside customer equal 60 equal 270 minimum transfer price 210 plus 60 270. The same case في A in A has excess capacity operating cost 0. في B in B no excess capacity, so the operating cost equal contribution margin 60. Original contribution margin 60. Assuming the appraisal department has no excess capacity. C relate to B. Assume the appraisal department has no excess capacity. Should management force the department to charge the home loan department only 265? Discuss. The answer is no, because by forcing the appraisal department to accept the 265 per appraisal price, management is penalizing the appraisal department. If the department was allowed to sell its services to outside customers, it can earn $60 in contribution margin per appraiser. Forcing them to sell these services internally would allow them to earn only $55. The difference between the transfer price 265 less new variable cost 210 in contribution margin. So the appraiser department will realize a loss of $5 per appraiser. The difference between 60 and 55, a loss of $5 per appraiser, or total 7,500. Expected 1,500 appraiser times $5 equal 7,500. Thank you. This next time we will take a new chapter.